Today, we're diving into a detailed analysis report focused on the massive 42% single-day spike in DJT stock following its announced merger with the nuclear fusion company TAE Technologies.
A $6 billion all-stock deal.
Exactly. So, a key theme running through this material seems to be the Tesla of energy argument, where DJT pivots from a media stock to a deep tech play because, AI needs massive amounts of electricity.
That's laid out very clearly, and you can feel the ambition in the analysis. But I wonder, if we've really bridged the immense gulf between that high-level vision and the current financial reality.
Okay.
The analysis report needs to ground the tech giant thesis in rigorous financial logic, moving beyond just aspirational synergy.
Tell us more about that. Where could the report really strengthen that financial grounding? I mean, the market obviously bought the story, right? A 42% spike says something.
It does, and the material brilliantly outlines the potential. That fusion plus AI is the holy grail. It's incredibly captivating, which explains the market reaction.
But that's also the weakness.
That's also the weakness. It doesn't adequately address the yawning financial chasm. You have a social media business generating what? Less than $1 million in revenue per quarter?
Right.
And that's now supposed to anchor a company valued at around $6 billion post-merger?
So, for listeners who might not be deep in the nuclear fusion space, what kind of capital are we talking about here? Can you give us an order of magnitude? Because $6 billion in valuation isn't the same as $6 billion in cash.
Not even close. And that is the crux of the issue. We're talking about CapEx in the hundreds of millions, maybe billions of dollars.
Just for one facility.
Just for the demonstration facility, let alone scaling it commercially. TAE Technologies has this ambitious, very capital-intensive timeline. They're aiming for a plant groundbreaking by 2026.
That's soon.
Very soon. And the analysis doesn't detail how the combined company with its tiny revenue stream is going to finance that. That financial plumbing, it's a foundational requirement for any credible analysis here.
So the argument needs to shift from the abstract AI needs power to the very concrete how do we pay for the reactors?
Precisely. The suggestion for improvement is to shift focus from the vision to the feasibility. How does this merged corporate structure actually support TAE's massive capital demands?
Does the public listing give them real leverage, or is it just inflated stock?
That's the question the report needs to answer. Does it help them attract institutional money and cheap debt, or is it just paper currency that they can't actually use to buy steel and concrete?
So it's about the quality of the market cap. What are some concrete ways the analysis can demonstrate that feasibility? How do you move it into that operational domain?
We need evidence, not just enthusiasm. So first, the report should investigate and project the post-merger balance sheet. What are the cash reserves? What is the immediate capital raising capacity? If they're serious about 2026, they need a path to funding now.
Not in a year?
Right. Second, the analysis should explicitly detail the financial mechanisms. Is it high-yield debt, a big secondary offering, which would, dilute shareholders even more? Are they using DJT's existing assets, whatever they may be?
Right.
That gap between the $6 billion paper valuation and the hard cash needed for construction has to be bridged. The report needs to show how.
And I think that third point you suggested about comparison is critical, especially for a more institutional audience.
Absolutely. You have to put that $6 billion figure in context. How does that valuation stack up against other pre-revenue, high CapEx ventures in clean energy or infrastructure?
To give it a defensible baseline.
Exactly. That's what separates a real valuation assessment from something that just looks like a meme stock spike. It lends credibility to the whole tech giant claim and moves the analysis from aspirational to operational.
That's a great framework. And thinking about how they bridge that gap leads us directly to the risks of the merger structure itself.
It does. So let's build on that and look at the risk assessment, specifically the structure of the deal.
Okay, I see where you're going. The material does correctly flag the reality check section. It notes the Hail Mary risk and the fact that it's a 50-50 all-stock deal, which means dilution.
Which is true. But the analysis needs to push deeper. Why does that dilution matter so much in this specific context? To elevate the analysis's credibility, the discussion of dilution and structural risk needs to be specific to this high-stakes, pre-revenue merger structure.
So the weakness isn't that it mentions dilution, but that it treats it like a generic run-of-the-mill risk.
Precisely. Saying a 50-50 all-stock split causes dilution is callous. That's Merger 101. It's accurate, but basic. This structure carries unique risks that are, I think, really underanalyzed here.
Okay.
Think about it. TAE owners are getting 50% of the public company based on a $6 billion valuation without having proven commercial viability.
Right.
So there's a huge structural risk. The public company is now completely dependent on an experimental technology succeeding on a very tight timeline. It's the fusion is hard problem, but now it's baked right into the capital structure.
And if I'm hearing this right, the risk isn't just that the stock price might go down, it's that the market's entire perception of the company could shift.
Exactly. From tech growth story to very risky R&D lab. And you mentioned capital quality before. An all-stock deal like this might be seen as lower quality capital than a traditional cash infusion.
Can you break that down? Why is that?
Well, when you raise cash, you have liquid funds for CapEx. The market sees that as real and deployable. When you issue stock, especially half the company, you're essentially swapping liquid shares for an unproven long-term asset.
So it doesn't actually provide the funding for that 2026 groundbreaking?
It doesn't. The report should explore how the market views this. Is the public float now basically a high-stakes venture capital fund? Are the old shareholders now involuntary R&D investors? That's the framing that's missing.
That's a powerful reframing. So what specific structural things should the report dig into to illustrate this risk shift?
Okay, so first, we need to look at the shareholder behavior. The analysis has to investigate the implied lockup agreements for the new TA shareholders. Do any exist?
Because they now own half the company.
They own half the company. And when those locks expire, you could see immense volatility. A huge block of speculative shares could hit the market all at once. That's a major structural vulnerability.
So the lockup expiration date isn't just a procedural detail, it's a ticking clock.
It's a ticking clock. Second, explore the volatility that could be created if key technical milestones aren't met. The analysis should stress this dependency. 50% of the company's valuation is tied to experimental physics, not revenue.
So if TA announces a 2-year delay on some reactor part,
The valuation of the whole company gets compromised immediately because half of your ownership base is that specific risk.
and that ties right back to the timeline from our first point, that 2026 groundbreaking.
Absolutely. If that 2026 timeline slips, the analysis should detail the immediate implications. How does the company maintain public confidence? What happens to the half of the float held by the fusion team? Does that trigger a crisis of confidence? That kind of depth moves the analysis way beyond just saying, dilution is a risk.
This is great. We've defined the financial needs and the structural risks. Now let's move to the market's reaction, the price action itself. Let's look at the section on technical analysis. The material correctly identifies the breakout above $10, the massive volume, and sets resistance levels at $17.50 and $20.
Okay. Yeah, what I like here is the clarity on the price levels. They're accurate. But there's a huge opportunity to make the whole report more compelling by connecting those lines on the chart to the fundamental debate we've been having.
So integrate them.
Right. The technical analysis section should be integrated directly into the fundamental drivers to create a cohesive narrative around market acceptance and risk management.
I see that. Right now it feels a little bit separate, like a different set of facts. What's the downside of that isolation?
Well, the weakness is that it's presented as just geometry on a chart. It doesn't explicitly tie the price movement to that underlying genius pivot versus Hail Mary story.
Okay.
For example, the mention of meme stock mania is just kind of there. It isn't connected to the technical significance of breaking through that $20 level. It makes the reader do all the work of interpretation.
But isn't there a risk if you do that? If you attach a narrative to a price point, say, calling a drop a bull trap, aren't you just engaging in fortune telling? How do you keep that objective?
That's a really important challenge. We're not asking for prediction. The idea is to use the chart as a real-time barometer of market consensus.
A map of conviction.
A map of conviction, exactly. The 42% spike is initial belief, but the resistance level should be treated as objective confirmation points for the deep tech thesis itself, not just random price targets.
That makes the data much more dynamic. So how can we reframe those specific price levels in the report, starting with the downside?
We can reframe the immediate support level, which the report puts at $13, as the critical point where the market might decide this whole deep tech move is a bull trap.
Okay.
If the price breaks below 13, the analysis should connect that technical failure directly to the bear case fundamentals, the CapEx needs, the unproven tech. It's where technical weakness validates the fundamental skepticism.
And looking up the chart, what about that $20 resistance level?
On the upside, breaking $20 would signify more than just the price move. It would be a genuine validation of the new energy infrastructure identity. Getting there, especially on volume, would signal the market is truly accepting the pivot.
And that could trigger the return of that meme stock interest you mentioned.
Exactly. But this time it would be anchored to a real, even if speculative, fundamental shift. It turns a price point into a psychological threshold.
And finally, that huge volume spike, 100 million shares. How do we integrate that?
That volume is key. The analysis needs to ask, what was it? Was it just short covering, which is a temporary mechanical thing that fades? Or was it new institutional money flowing in, voting with their dollars to validate that $6 billion valuation?
Right.
Integrating that volume spike into the discussion of whether the market truly accepts the fusion plus AI synergy, that's what transforms the report from a summary into a cohesive, high-impact investment thesis.
This has been a tremendously insightful